Good morning and welcome to the Global Financial Leaders Investment Summit. Today we are having conversations with global investors, and that means you today here at our event, jointly organized by the Hong Kong Monetary Authority and the Hong Kong Academy of Finance. Now, Hong Kong, as a world-leading global financial center, is constantly in dialogue with global investors and regulators around the world and the facilitators that power global finance. And that conversation has never been more necessary than now. Right now, we face a time of rising inflation, of high interest rates, a time of high and rising government debts and other storm clouds on the horizon. But it is also a time with greater focus on financial inclusion, on ESG, on exciting new fintech, changing how we do business, and even evolutionary changes to the nature of money itself. To help us to grasp these different developments, we have two fantastic panels today with global asset managers and alternative managers, and they are going to be discussing these developments and giving you a much clearer view on how you can manage risks and how you can seize opportunities. To open today's proceedings, we would like to welcome a fellow of the Hong Kong Academy of Finance, who is also the chairman of the Hong Kong Exchanges and Clearing. For decades, she has lent her quiet wisdom to the highest level bodies in government, universities, and financial bodies in Hong Kong and in mainland China. Ladies and gentlemen, today we welcome the chairman of the Hong Kong Exchanges and Clearing, Mrs. Laura Cha.
Financial Secretary, Eddie, distinguished guests, ladies and gentlemen. On behalf of HKEX, I wish you all a very warm welcome to our Connect Hall. Today's event is jointly sponsored by the HKMA and the Hong Kong Academy of Finance as the concluding session of the very successful Global Financial Leaders Investment Summit, which took place last 2 days. I'm sure you will all agree that the dinner at the M+ Museum earlier this week, as well as the very full, outstanding, and impactful sessions that we had yesterday, had all been exhilarating and energizing. Today's session, as a finale, will be just as stimulating. This morning's conversation will focus on creating value during uncertain and challenging times. From where HKEX sits at the heart of Asia's financial markets, we see connectivity as the essential ingredient in building continued resilience, in unleashing the opportunity across the region, and in navigating the inevitable challenges ahead. It is our belief that it is only through connectivity that we will deliver a shared, sustainable, and successful future. We see it in all industries, markets, and economies. Connectivity is essential. We hear it in our conversations, be those with government officials, companies, entrepreneurs, investors, innovators, in any context that we come into. Connectivity is essential. We hear regionalization these days instead of globalization, but regionalization cannot exist by its own in isolation. Regions still need to be connected. The world has always needed and will always need connectivity. And in a fragmented world, we need connectivity more than ever. Hong Kong has always been a super connector. Connectivity is what defines our city as an international financial center. Our role as an East-West super connector is unrivaled anywhere. The global headwinds that will be discussed here today are reminders of the important role that Hong Kong and Hong Kong EX have played in a world that is buffeted by geopolitical tensions, macroeconomic turbulence and uncertainty, and climate change, and more. Recent announcement by the China Security Regulatory Commission on enhancement to the Connect scheme that we have indicate again the importance of Hong Kong as a connectivity region to the global success. At HKEX, we see great opportunities for Hong Kong to support the megatrends that are shaping the global landscape. Megatrends such as China's next phase of economic growth, the global sustainability agenda, the rise of the new economy sector, biotechnology, innovations, and many more. And we are proud to play our part through our role in connecting China with the world, in connecting capital with opportunities, connecting today with tomorrow, and simply, like today, hosting an event where we gathered, connecting all the international financial community. This is what we do best. This is what Hong Kong does best. It is great to be connected, and I would like to thank the HKMA and the Hong Kong Academy of Finance for organizing today's event. I wish all a very successful and enjoyable session, and I look forward to many more opportunities to welcome you to our Connect Hall in the future. Thank you.
Thank you very much, Mrs. Chia. The epitome of a super connector all by herself. We would now like to welcome to the stage the honorary president of the Hong Kong Academy of Finance. Since 2017, he has been responsible with his team, with the entire body of his government, for the main vehicle through which Hong Kong policy is made reality, the budget. The different institutions and government bodies that are responsible for Hong Kong's financial and regulatory environment and even its economic development all fall under his purview. He is the financial secretary of the Hong Kong Special Administrative Region of the People's Republic of China. Please welcome Mr. Paul Chan.
Laura, Eddie, distinguished guests and speakers, ladies and gentlemen, good morning. I'm so glad to see you all after the fruitful panel discussions of the Investment Summit yesterday. I hope you all feel recharged and energized. Today's discussion, Conversations with Global Investors, will focus on how investors could position themselves to manage risks and capture future opportunities. It just can't be more timely. While I look forward to panelists sharing of their valuable insights in their respective investment areas, I would like to share how Hong Kong has weathered through the risks and volatilities in our financial markets. To set the scene, let us acknowledge that the global economic outlook and the investment environment are extremely challenging to everyone. Supply chain disruptions have failed to ease following the 3-year COVID-19 epidemic, aggravated by geopolitical tensions, particularly those from Russia-Ukraine conflict this year. Inflation in advanced economies has been pushed to levels not seen for decades. Aggressive, prolonged tightening of monetary policies by central banks to curb inflation will further dampen global demand and investment. Hong Kong is an IFC, but we are also a small and open economy. We virtually have no natural resources and rely heavily on external trade and investment. Our economy is highly susceptible to external volatility. Turmoil in markets outside is destined to impact on Hong Kong. At a city level, how do we manage financial market risks brought by a world characterized by high uncertainties and volatility? Central to this is our belief that we must deal with security and development together in a well-coordinated manner. Security and development are two mutually dependent subjects. Financial stability is an integral part of financial security, which is the prerequisite for economic development. Yet economic development provides the best support to security, as it strengthens our ability and capability to fend off challenges and risks. That is why over the past 3 years, we have paid much attention to ensuring our financial stability and security. First, we have established a surveillance system to detect risks in our financial market. Together with financial regulators, we have adopted a cross-market, coordinated, and round-the-clock monitoring mechanism over all sectors of the financial markets. It provides, on a rolling basis, regular and in-depth reports, as well as ad hoc reports of the markets to enable us to detect if risks have been building up. Second, we have stringent capital and other requirements of the regulators. We regulate and conduct on-site inspections and stress test them on both regular and ad hoc basis to ensure that they have conducted themselves properly and they are resilient, and reports filed by them are accurate and complete. We will act decisively as and when necessary. Third, we maintain strict discipline and build strong buffers in preparation for turbulences. Take our banks as an example. In Hong Kong, the capital adequacy ratio of banks currently stands at about 20%, which is way higher than the international standard of 8%. Their liquidity ratio is around 155%, compared to international standard of 100%. Classified loan ratio is just about 1%. Our banking system had assets of $3.3 trillion as at the end of last year, more than 9 times of our GDP. One aspect of financial stability that critics like to talk about during times of volatility is Hong Kong dollar exchange rate under the linked exchange rate system. Over the years, we keep the exchange rate of Hong Kong dollars at US $1 to Hong Kong 7.75 to 7.85. When the strong or weak side of the band is touched, the Hong Kong Monetary Authority will come in to take or give Hong Kong dollars in accordance with the system design. The consequential increase or decrease in the aggregate balance will trigger interest rate adjustment, and the market will eventually find its equilibrium. As mentioned above, we have built very strong buffers and resilience in the banking system to support this, and we have been exercising strict discipline to keep the capital inflow in liquid US dollar denominated instruments so that we can pay them back anytime. It is all the more worth mentioning that our foreign currency reserves stands at around $430 billion, equivalent to about 1.7 times of the Hong Kong monetary base. So, If you bet against Hong Kong dollar, you are bound to lose. You can verify my advice with certain hedge fund managers in the US who has been wrong about Hong Kong dollar time and again. As for securities, Hong Kong's stock market is vibrant, active, highly liquid, efficient, and transparent, attracting investors from all over the world. We attach great importance to investor protection as well. We believe that for a market to succeed in the long term, it must be trusted by both market participants and investors. To achieve this, we set clear rules for our markets, stringent requirements on the participants, maintain high transparency of its functioning, ensuring that policies and practices are implemented in a consistent and predictable manner, for they are the cornerstone of international investors' confidence in Hong Kong market, where they can make use for investment and fundraising. The stock market in Hong Kong has been quite volatile recently. There have been calls that the Hong Kong SAR government should do something, for example, about short selling in the market. Let me tell you that on a daily basis, we analyze in depth the performance of our markets. For example, factors causing such volatility is performance vis-à-vis markets in the region and the global markets, the short selling volume and the underlying reasons, who are the players, relationship between short selling and short positions, any concentration risks. We also look at the futures market as well as the derivatives market. We also analyze the information in the trade repository system. Basically, so far, there was no cause for alarm. We also look at the clearinghouse, licensed corporations, and the mutual funds to ensure that they are financially sound and resilient. In short, amid market volatility, we focus on whether the markets are functioning orderly and properly, and whether there are systematic risks, irregularities, and vulnerabilities that will threaten Hong Kong's financial stability. Ladies and gentlemen, I hope my sharing on our philosophy and approach towards market regulation has facilitated better understanding and inspire more trust in our system and our markets. Hong Kong is an IFC with an internationally aligned regulatory regime, deep liquidity, great transparency, and much resilience. With proper safeguards to protect investors, we are simply the best IFC in Asia. You are most welcome to do business and make more investments here. I wish you all good health and the best of business in the coming year. Thank you.
Thank you. Thank you very much, Mr. Financial Secretary. We know that you moved heaven and very sandy earth to be here with us this week, and we do appreciate it. Thank you again. Thank you. You, Mr. Secretary, you've had to deal with volatility as we all have done in our business, and the mandate of our next panel is to determine how we can create value in these uncertain times. Fortunately, we have a very able moderator who is going to guide us through the next discussion. Now, many of you know him through his many, many professional achievements in the world of finance. But I would also like to let you know that you have to get your hands on his books. and give them to your friends for the Christmas season. Out of the Goby and money games is a great way to get started. And once you've got those done, you'll be ready just in time for his new book coming out in early 2023. We will be hot down to Bookazine to get our copy of Money Machine, a trailblazing American venture in China. So with that, I will welcome our moderator to the stage. He is the executive chairman of PAG. Please welcome Wei Jin Shan. Thank you for joining us. Yes, please. Yes, sir. You are right here in chair number 1 as our moderator. We'd like to welcome our panelists in rapid fire. We have William E. Conway Jr., who is the co-founder, the interim CEO, and the co-chairman of Carlyle. There you go. He is going to be followed by Luke Ellis, who is the CEO at Man Group. Thank you very much, Mr. Ellis, for joining us. We would like to welcome Ben Wei, who is the group head for Macquarie Asset Management. And thank you. And Jim Zelter, the co-president of Apollo Asset Management. And with that, thank you. Mr. Shan, the floor is yours. Thank you.
Thank you very much. Good morning, everyone. Good morning, ladies and gentlemen. Congratulations, Paul, Eddie, Laura, for this very successful summit so far. And it's so delightful to see Hong Kong opening up like what we're doing right now. And today, I'm extremely honored to moderate this very distinguished panel of leaders in the alternative asset management industry. And these are all veteran investors, and they have been through many economic cycles. In the past day or so, we have heard many people talking about challenges facing the global economy. Top on everybody's list is high inflation rate. And then we talk about geopolitical risks. Now in the United States, inflation rate is now more than 8%. And we know that the interest rate is about 4%, coming up from 25 basis points about this time of last year. I think it is probably just a matter of time that the economy in the United States will slow down sharply. And we know that this year, the economic growth rate for the country is suspected to be about 1.5%. So we know there are challenges over there. However, the labor market remains quite tight. Unemployment rate is 3.5%. So it's questionable where the US economy is going to be next year. Now, if you look at Europe, the situation is much worse. Inflation rate now is double digit, exceeding 11%. Interest rate is still quite low at 1.5%. And growth rate this year, I think, is probably at best 1% or slightly more than 1%. So indeed, inflation is a major challenge in the developed world. Central banks will keep raising interest rates, which may not be high enough to tame the inflation rate, but may be high enough to push the economies into a recession. So we worry about it. But here we're in Asia. And if you look at Asia, you talk about the high inflation rate, you ask the question where the high inflation rate is. Just look at China, right? Where the inflation rate, the last I saw, was 2.8%. It's very tame. Where's the interest rates? Well, interest rates last year was 5%, and this year is 3.65%. So the monetary policy, as Governor Yi Gang yesterday pointed out, is accommodative, very different from the Western world. However, the Chinese economy is sharply slowing down, as we know. The target for economic growth rate was 5.5%. But in the first 3 quarters, it registered about 3%. I would think barely. And it's still not possible to tell what the full year number will be. So we have challenges in that particular economy. Then you look at Japan. Where is inflation rate? Well, Japan's inflation rate is 2.6%. So it's very low, and Japan is still trying to reflate its economy. Whereas the interest rate in Japan is minus 10 basis points. It's still negative interest rate. And the Japanese yen has dropped more than 30% in the past 18 months. We're all dollar-denominated investors. So if you think that Asia is attractive, well, you have to watch about your currencies, because the depreciation in currencies will have major impact on our returns. Now, I mentioned these 4 economic regions: United States, the EU, China, and Japan, because 4 of them represent about 2/3 of the world economy. For the United States, it's about 24% of the world economy. For China, it's about 18%. For EU, about 17%. Japan is relatively small at 5%, but Japan is very significant for the Asian economy. So looking at this just 4 major economic bodies in the world, one question that comes to mind, and that is, at this very moment, not tomorrow, not next year, not 2 years from now, at this very moment, which market of the 4 is the most attractive? Where would you bet your money? We know all the challenges, we know all the difficulties all around the world. So where would you bet your money? And may I start with Bill?
You sure you don't want to start with one of these other?
The reason I start from you is because you are in the buyout space. You're in private equity buyout space. You know, I could start with Ben. He's in real assets. I know he's probably now going to be very keen on investing in real estate in China.
Well, thank you for the introduction, and it's great to be here back in Hong Kong. I think that first of all, I have to give a couple of caveats, which is that if you were to have asked any of us a year or 2 ago what we thought things were going to be like a year or 2 later, that is now, we all would have been wrong. And so any prediction people make should be understood in that light. Secondly, our analysis shows that there's very little correlation between the performance of the economy and the performance of equity markets. And of course, that's kind of counterintuitive to everybody who thinks, you know, a strong market, strong economy, the market's going to go up. That's the place where I want to invest. It just has not been the case, frankly. Having said that, while it's always tough, frankly, for somebody with a dollar brain and brought up and educated in America to bet against America, I think for me, the market I probably prefer the most today would be Japan. And part of that is because I do have a dollar brain, and I see that the yen has gone from 105 to 150 in a matter of months, and everything's on sale in Japan for people who have dollars. And I think that it's something to take advantage of. Maybe it'll go to 160 or 170, I don't know, but I think that there are going to be very attractive transactions done then. You know, you asked about now. I think if you were to think about a little longer, you'd think of other places perhaps to invest, but you didn't ask me that.
Well, you can ask yourself.
Well, I do. And in addition, remember, private equity is kind of different than other businesses, yes, because we count on our limited partners to provide the money that we raise from them. And so I have 800 investment professionals around the world in all different kinds of asset classes and geographies. And their job is to find deals to do. But a private equity fund is invested over a period of 3 or 4 or 5 years. It's not invested all right away. And so I think a couple of years from now, Europe will be on sale. because it's so horrible there and likely to get worse that I'd probably think that would be an attractive market, but not yet, too soon.
So you suggest that Japan is a good place to place your bet today. Remember that. But Japanese yen is very weak. How do you deal with the currency risk over there?
Well, generally, we hedge our equity position to the dollar. I don't know that I'd do that necessarily today, although I'm not a professional currency hedger, and I like to make money on the performance of our businesses as opposed to the performance of the currencies. But I think that the currency is likely to be weak as long as the Japanese economy and the people running it are focused on trying to increase inflation and going to keep their interest rates negative. And they seem committed to that policy. And what balances those policies is the currency. And the currency's had to weaken to compensate for that. And one would say maybe that isn't going to change anytime soon. The currency will continue to weaken. So I probably would hedge the equity position and hope to make a significant gain on which I'd leave unhedged.
I think the good thing about Japan is that the currency is infinitely hedgeable because the Japanese interest rate is so low. And hedging cost is a function of interest rate differentials between the Japanese yen and the US dollars. And now with Japanese interest rate being negative, people will pay you to bet against yen. So you get a carry, positive carry, by hedging against Japanese yen. And therefore, Japan's cheap is hedgeable.
Well, and I might add, and obviously the other panelists know a lot more about some of this than I do, that another advantage in investing in private equity in Japan is that you can borrow money so cheaply.
Yes.
The rates there are TIBOR, which is the rough equivalent of LIBOR or SOFR, at 0, and plus 1.5% or 2%. So it's just cheap to borrow, and the leverage you can put on the transactions inflates the equity returns as well.
It's free money, it's good leverage. But look, you invest in public market. Man Group is a leading asset manager by investing in the public market. And Bill just mentioned in private equity, you can keep an investment for 3-5 years or even longer. You can ride through the rough patches like what we're facing today. But in public market, you mark the market on a daily basis. So what's your pick?
So I would say trying to pick one thing today is a bad answer to the current investment problem. So we're in a world where inflation has got out in some countries. We have a very different economic situation in China. As you mentioned, we can come back to Japan. We have dispersion around the globe. And in a world of dispersion, in a world of economic uncertainty, picking one thing and sticking with it is not the right answer to investing a portfolio. For investors, the last 10 years has been, frankly, as easy a world as you'll ever see. You just had to buy something, frankly, as much of anything as you could, as much leverage as you could. Everything went up. So it was a very easy world to be an institutional investor. That world's gone. We're in a new paradigm, which I suspect will last years rather than months. And in the new world, you need to be active in terms of your asset allocation. So you can buy companies and hold them for 10 years and transform them, and the private equity world can work very well. But if you're investing in public markets, thinking there is one simple asset allocation in today's world, I would say is wrong. This year, clearly being short the interest rates, particularly US, has been a fantastic thing. Being long the dollar has been a great thing. Being short equities has been a great thing. There's been some big currency moves. The yen has been a fantastic move, but you also have to look at what's happening to price changes over time. So the interesting thing, last night, the Fed, honestly, I don't know how anybody could have been surprised that Powell was hawkish after raising 75 basis points. He's got to be until you have some sense inflation is coming down. But the market was surprised. But the interesting thing is what you saw was a big sell-off in equities and not very much of a move in the dollar, not very much of a move in interest rates. It gives you a sense that, the long dollar trade that's been, not against the Hong Kong, of course, I would say, by the way, anybody who bets against pegs that's a dumb way to try and make money. They all remember the one time that they made money, you know, so if you happen to be the right way around on Swiss franc against euro when it broke, great, but it's a terrible way to try and make money over time. You remember the one time it worked and you forget the 20 years it hasn't worked, or even longer here. So we don't do that one. You'll be pleased to know. But you know, look, there are some currencies in the region where being long the dollar and short those currencies has been a fantastic move all year. But you can sense that trade's getting tired. And so maybe that was what Bill was suggesting in the question of whether to hedge. So we run a very active style. So, you know, right today, yeah, I'm still long the dollar and short bonds and very happy with it. But do I think I'll have the same position by the end of the year? No, probably not.
So you don't think that any particular market or the four markets I just mentioned is the most attractive? You diversify geographically. Do you care to tell this audience how you are diversified geographically? How you have allocated your capital
sure.
among the four that I have just mentioned?
Yeah, look, I think that so we're a believer in maximum diversification unless you have knowledge, right? And so there are some things that one can have real confidence in and some things not. I think there is nothing worse than being the European equity strategist. There's a very nice guy who's a friend at Goldman who every Monday has to write, I guess he does it on a Sunday, a note that says, this is why now is the moment to buy European equities. And he's been doing it for 10 years and it's not been the moment yet. And got to say, it doesn't feel the moment yet. I would agree from an equity market point of view that actually Japan is about the most attractive. I think if you were the central bank, there was a lot of conversation yesterday about the challenges different central bankers face. I would say for many it's a very clear story, but it's just whether they're willing to go through the pain to do what they need to do. In Japan, it's a very difficult story because, you know, they've had 30 years of deflation, right? The deflationary things are so embedded in Japan, and they have no wage inflation. Now, you know, the reason the US has got to keep raising rates is you've got 7% plus wage inflation with a target of 2% inflation. You've got to get unemployment up. You've got to get wage inflation down. That's the only way to get unemployment. Yeah. Japan has a different problem. They have for 30 years had zero wage inflation, and you can't get sustainable inflation up to 2% without some wage inflation. And they only have a once-a-year wage round. Japan likes to do things differently. That's the sort of, you know, whatever the joy and the annoyance of Japan. They have their own way, they do it their way. And essentially all wages in the country are set in March and April. And so the central bank is stuck in a place where they have to keep the stimulatory position until we get through the wage round in the hope that there will be wage inflation, at which point they have to then get out of a position which is horrible, right? Because if the yen has been a big move and, you know, when they let go of 10-year JGBs, they're not going from 25 basis points to 50 basis points, right? When they let go, it's going to go a very long way. And you can see that in you only have to go out to 15-year JGBs that are 1.5% now, and you could see how far the market wants to move. So they're holding on to a very tightened coil, which I would say that would be the least attractive job to be the central banker. And by the way, it's available if anybody wants to apply, because Kuroda finishes in March and someone's got to take on the challenge.
I agree. I think Japan is in a bind because if you look at the United States, the government debt is about $32 trillion. So 1% increase is equivalent to about $322 or $320 billion. That's a big number, $320 billion from 1% increase in the interest rate for the US government. But in the United States, federal government debt is only about 100% of GDP. And in Japan, it's about 260% of GDP, the highest ever in the world. Think about a 1% increase in
yes, but
the
most
interest
of it's
rate for
not
Japan.
real debt. Most of it's owned by, it's either mostly owned by the Ministry of Finance and the Bank of Japan, or then GPIF, which is another version of the same thing. So
there's no question
you have
about
to
it.
look at external debt to look at the debt you worry about.
Right. Well, there's enough holding of government bonds by foreigners for the Japanese yen bonds. But in any case, let's go to Jim. You are very much active in the credit markets. But Apollo, I understand, is a diversified alternative asset manager. So you're in private equity, you're in buyouts, you're in credits, you're in everything. So from your point of view, going back to my earlier question, which market is the most attractive?
Well, I'll say a few things. I have a long shopping list. You're right, at Apollo, we oversee about $550 billion of a variety of assets, really private equity, credit, and yield. But, I think unabashedly the most interesting opportunity right now is U.S. credit. Certainly we are, and yesterday's panel did a great job, James Gorman, about summarizing where we are. I was an econ major in college. I don't need to go through the backdrop. I would add one thing, though. In the U.S., since the financial crisis, the backdrop of how the financial system works has changed dramatically. The advent of private credit from institutions, sovereign funds, folks like us, it's a large part of the market right now. So the lack of confidence has created a vacuum. And right now, specifically, you can do a few things in credit. You can buy low dollar investment grade credit and have convexity the first time in 15 years. And I would argue over the next 12 to 18 months, mid double digit returns, 12 to 15% on that. You can be the provider of credit in large quality buyouts that Bill is doing or the folks at Blackstone are doing. On the Emerson financing yesterday, you can arguably make 10 to 12% top of the capital structure, 20% LTV. The third thing you can do is because of the overhang in the U.S. banks right now, which is around $100 billion of commitments they've made, contrast that to $500 billion in 08-09, they are not making new commitments. At the same time, companies need to borrow money. Royal Caribbean, Caribbean Cruise Lines, they're coming into the market right now paying you 8.5%, 9%, 10%, top of the capital structure, 2 or 3 times multiples debt to valuation on a company that has a tremendous equity cushion underneath you. So there's a variety of activities in credit in the U.S. I can also talk about equity secondaries. People talk about the denominator effect. Very interesting business. And Bill and I did compare notes. I'm also a big believer in Japan private equity. So I think if you ask me point blank right now, U.S. credit, private credit, investment grade discount paper, and a variety of other, I don't want to say rescue, but being able to work with the banks as they are not as fluid and as flush as they are. I contrast that to what's going on in this region of the globe. Obviously, the strength of the HKMA and the banking system is extraordinary here. And the markets are not broadly developed such that these avenues and cracks don't exist for folks like us to operate. But this is an amazingly interesting time. It's going to be a cloudy storm. It's going to last, as Bill said, who knows? We're very poor at predicting. We're very good at preparing. But the fact is, we were lamenting a year ago about making 4 and 5%, and I can't predict the future, but if I'm making these high single digits, low double digits, and I'm getting current cash pay today, I feel very comfortable that my downside is protected and I'm going to do very well over time. And this is the opportunity set right now. We are unabashedly very busy. We're unabashedly putting a lot of money to work. And the great irony is all of this, and I know both sides of the equation since we're in it, the great time to invest in private equity is periods like this where there is uncertainty and there's unfortunately not a lot of financing. Same argument with real estate opportunity funds. And so the irony is, as much equity has been raised, the fact is there's not a lot of financing for those transactions. So price levels will come down, but it will be an amazing vintage, 23, 24. These, I believe, will be great vintages, especially in the US and Europe in due course.
In Europe as well?
I think it's going to be a bit later. I mean, certainly there's a lot to do right now in the US. You know, we have a very large business in Europe that buys European non-performing assets from the banks. I believe they're going to go through a period of time like Asia did in the late 90s, either Japan or Korea, other places that had to get their banking system in better shape. You know, the collective ROE on European banks in the last decade has been sub 5%. That has to be dealt with over the next 3 to 5 years. So again, back to your specific question, US credit, a lot of sub-strategies, a lot of great partners in the room that are doing it with us, but unabashedly love that asset class. Equity secondaries, and because of what's going on with the denominator effect, and also, you know, I'm happy to talk about distressed and Chinese NPLs and many other things, but to your pointed specific question, that's where I'm an unabashed bull.
You know, I'm not quite sure if everybody understands what denominator effect means in private equity. See, our institutional investors, that is limited partners of private equity firms, would allocate capital among or between, let's say, public equity and private equity. Let's say if the rule is they allocate 80% to public market and 20% to the private market. In today's market conditions, the public market has dropped quite significantly. Then they look at their portfolio, all of a sudden the public market has shrunk from 80% to, let's say, 70% or 60%. Then their private equity book has expanded from, let's say, 20% to 30%, even 40%. All of a sudden, they're out of whack, and they will have to reallocate. And that's the so-called denominator effect, because the public market value has dropped, and therefore they will have to reallocate by selling in the secondary market their private equity positions. Sorry, I have.
No, you did a great job, and I think the point that I really want to make here is we're all a lot of economic prognostication, which is very important, but I would really urge investors to be student of how the markets really work. And what I mean by that is how companies finance, and we've been in this decade plus of, you know, the advancement in the equity markets of technology, ETFs, which create market structure challenges. And if you are a thoughtful investor, understanding that dynamic and using periods right now of uncertainty to your potential advantage. You use the luxury of your liquidity or the long duration of your capital to be providing capital in periods of vacuums right now. I think there's a few big lessons, and I'm just going to go off script for a moment. Certainly what is perceived or what has been perceived as safe, you know, long-dated, you know, UK governments that have gone from 102 to 38 this past 9 months, that liquidity that people perceive they needed is unnecessary. And so thinking about this market structure and how you asset allocate and how you invest, I think is a critical point to remember in these periods of uncertainty.
Thank you. May I turn to Ben, who is head of Macquarie's Real Assets Management, a big investor in real assets, real estate, infrastructure. So we have just talked about you know, some specific markets are particularly challenging, but what's your pick?
Thank you, Shan. And first, let me say, Finance Secretary and Eddie, thank you so much for the last few days. As someone who was a long-term resident of Hong Kong, the excitement around the city, the excitement in our office to see people that are here talking about these sorts of issues has been great. So I think everyone's thankful, and it certainly feels like we're back. So thank you to you. I've sat across the table from Shan in other circumstances, and he sets good homework. So I have thought about this, Shan. I know you don't always think I've thought about your questions in other deal meetings and other things, but I have certainly thought about it today. I get the Japan trade, particularly if you're looking at it from a private equity point of view. I think if you're looking at it from a real assets point of view, you know, we've spent 20 years trying to find good deployment opportunities in Japan, and we're still trying. So that's a market. While I get the currency trade, and we'd love to have a bigger position there. Unfortunately, that's a little bit more challenging for the many things that we do around real assets. I'd say, you know, the most exciting market right today is the US, and I think about things like the Inflation Reduction Act, which I'm not sure will reduce inflation, but it has created a lot of investment opportunities and a lot of positivity, I think, around real assets in the US. And I think that's also matched by the fact that we are seeing a lot of innovation in the US beyond just traditional renewables. As economies, as states transition and think about what's next, both in terms of adapting their current energy mix, but also retooling their cities, and then thinking about the sort of renewables 2.0 around things like hydrogen and storage and other things. So I think if you're a US dollar investor today and you're thinking about where can you deploy capital in a market that's incredibly competitive and innovative, I think it would be the US. And I think if you have a look at, you know, what's happening, say, specifically in infrastructure, you know, last year was, for the top 100 infrastructure managers, the biggest fundraising year on record. And so I think we're starting to see infrastructure somewhat come out of the shadow of private equity, which has really been, you know, I think for us, been the standard bearer asset class around the world for the sorts of things we do, because they're very similar. And we're now starting to see a real need for private infrastructure capital around the world, and that's exciting. One, because we've got really more great managers providing more choice to clients. It creates more competition in the market, but most importantly, for communities around the world, it's capitalizing capital to address the most important issues that we're facing, which is either rebuilding nations after COVID, where it's helping with energy security, energy transition, and addressing really big challenges like how we actually get to net zero by 2050. And I think at the moment the US is leading on that, and for, you know, other reasons in terms of, I suppose, just access and currency, that makes a really attractive market. The second market, which, you know, no one's talked about today, but the second, I think, most exciting infrastructure market in the world is clearly China. And again, the scale of opportunity in China, the very positive policies around renewable energy, but also the investment around things like hydrogen and scaling up hydrogen and reducing the cost is very real in China, unlike it is in many other markets. And I think, you know, what is often lost is, you know, we all read, you know, certain media outlets, and there's still a debate going on in a lot of those media outlets about, will hydrogen ever be investable? Yet, just to the north of us, people are building scale hydrogen businesses together. They've passed that Rubicon. And so what's exciting, I think, about markets like, you know, like China is that a lot of real asset classes, which in some other markets are still considered to be sort of at their early stages, are starting to become scale. And that creates a whole new set of sectors. And I think it's akin to sort of to data centers. You know, in private equity funds, in infrastructure funds, no one really had much exposure to data centers 10 years ago. You know, if anyone's been pitched a private equity fund or a infrastructure fund in the last couple of years, front and center is data centers, because it's become a scale asset class, and so that's exciting. And so while I think digital infrastructure still offers a lot of opportunities, particularly in places like the US and China, I think it's interesting that we're starting to see a whole range of new asset classes kind of become scale, and that will present opportunities, particularly for investors who are not so worried or stressed about yield today. And there are a lot of investors who have a real need to manage for yield right today and have an issue around liquidity. But those who can allocate parts of their portfolio, allowing for the denominator effect, to longer-term assets over 5 to 10 years. I think they're the asset classes in the markets that are particularly exciting.
I agree with you. I think infrastructure is a wide space. Perhaps around the world, there are opportunities in the United States, in China, talking about energy, clean energy, talking about data center, using clean energy. PAG itself is a big investor in data center business. We also control the largest producer of industrial gases in China, producing oxygen, nitrogen, hydrogen, and so forth. Noble gases, the prices went up several times this year, and those are the gases for the semiconductor industry. But when we took this company private in Hong Kong, it used to be listed on Hong Kong Stock Exchange in 2017. It didn't have any new energy business, clean energy business at all. And this is a company which generated $1 billion EBITDA cash flow last year, so it's a very big company. Today, clean energy, including hydrogen, represents 25% of their revenue. So it's growing up in China very, very quickly. And this company has 40% market share in China. That underscores your point. But you're talking about infrastructure. You're talking about data centers. You're talking about clean energy. And another side of real assets investments is real estate. Commercial real estate, residential real estate. I don't assume you think that real estate in the United States, in China, are also very attractive in this environment, especially in the United States where interest rates are rising?
So in answer to your question, and I think Jim touched on before, real estate is a small part of what we do, and we primarily do opportunistic real estate. So it's really finding thematics around the world where there's not enough inventory and where there's capital required, and addressing that need, as opposed to having sort of core funds of residential or property real estate around the world. But I would agree with you. I do think real estate in certain markets, particularly if you're looking at long-term core portfolios, is difficult to invest in at the moment, particularly where we find ourselves from a funding point of view. And so I don't think that's particularly attractive. But there are other aspects to real assets that I do think provide attractiveness outside of real estate. And I think one of those is, say, agriculture. And agriculture as a real asset class, I think, is incredibly exciting. And there are a few reasons for that. And I think the first one is, food is not particularly correlated to GDP. People need to eat, and there is actually a scarcity of high-quality food supplies to the world. So while the world continues to want more almonds, more raspberries, more blueberries, more Wagyu beef, more red wine, more Australian lobsters, wants more of that, there's actually less providers of it and less arable land that's providing it. So I think, first of all, that's a really interesting asset class as people think about if I want to have an allocation to a real asset, but real estate doesn't make sense today, which I think we can all understand the reasons for, there are other asset classes that I think are really interesting. And I think the second thing about agriculture is also the fact that technology has really changed what you can do from an agricultural point of view. I think a little bit, Shan, like your point about the gas businesses that you own in China and we own in other markets around the world like Korea, where if you think about a farm today versus 10 years ago, the technology's changed significantly. And so not only can you use that land to produce proteins or to produce vegetables and other products, you can also use that land for carbon abatement. You can also use that for renewable energy, particularly with the increased improvements in transmission technology. So once what was a farm with, say, one revenue stream, you've now been able to pivot and create 3 or 4 revenue streams. And the important thing about those revenue streams is you're actually having an impact often from a net zero point of view. And so, we're farming much more efficiently. We're able to use that land much better than ever before. And that's also in a lot of communities around the world, whether it be in the US, whether it be in South America, China, or Australia. That's also a great story in terms of economic inclusion. because often where those farms are positioned, there haven't been a lot of jobs, and we're able to create more jobs using that land than ever before, and that's actually helping communities, rural communities, rebuild themselves. And so there is, from an impact investing point of view, in the sense of wanting to get great returns for clients from real assets, but also have a positive impact for everyone in your community. There are lots of assets that are now presenting that just we didn't have the technology or the wherewithal 5, 10, 15 years ago.
Very good point. Let me change gear a little bit and come back to Bill. PAG is also in the private equity business, and I have observed over the years a great difference in how we do business here in Asia and how business is conducted in the United States. In Western markets, financing typically is very much available for acquisition business, for buyouts, going back to Jim's point. So in the United States, for example, and in Europe, when you do a buyout, you typically can borrow 6 times or even 7 times EBITDA or cash flow of the targeted company to do your acquisition. So you combine your equity capital with a lot of borrowing to do acquisition. And therefore, when the interest rate is very low, buyout activity is very high, because like in Japan, money is free and you can lever up your equity capital to do very large acquisitions. Now, Jim just talked about providing private credit capital to buyout firms at double-digit interest rate, or high single-digit or low double-digit interest rate. In view of that, in view of the fact that senior financing is becoming increasingly scarce, banks are withholding credit, do you think that buyout activities in this kind of market, in the Western market, will slow down? Now compare it with in Asia. For example, we manage about $50 billion, which of course is dwarfed by the AUM that all of you manage. But in China, where we also have rather large exposure, the average leverage, EBITDA multiple, in terms of leverage, we have is just 2 times, because financing is not so much available. So you generate returns in a country like China by tagging along with economic growth. You can still generate private equity type of returns without leverage in China, because the economic growth rate is rather high. In the Western market, where the growth rate is typically 2 to 3%, without leverage, you wouldn't be able to generate 20, 30% returns for private equity investment. Now in Japan, without leverage, you won't be able to generate 20% returns, right, at all. So now the interest rates are rising, and credit is much less available. How does that affect the buyout market? How does that affect private equity investments?
Well, in the third quarter, globally, M&A activity was down 50%. And a lot of that had to do with the fact that there's much less availability of debt capital. I do think that private debt, as opposed to private equity, private debt is really the present and the future. It's going to continue to grow as share as private equity grows as its share of the equity. I think private debt will grow as its share of the debt. You're right about the amount of debt that's available in Asia, or that is commonly used anyway, and it's much less here than it is in America and in Europe. I'd like to make a comment, though, if I could, about China that might be somewhat relevant, I think, for everybody in the audience, which is a statement of the obvious, which is that when I first started coming to Hong Kong, or even before then, the GNP of China was $350 billion. And I think this year...
Which year was that?
Huh?
Which year?
1990. And here, in 2021 or 2022, the GNP of China is going to be $17 or $18 trillion.
Yes.
And so the people running China for the last 30 years they were doing a lot of things right. And when one thinks about the future, do you think China's going to be smaller tomorrow than it is today? No. And I don't think people should. You may argue, well, the people running China now will do it different than the people did then or whatever, but it's a spectacular track record that they built, and I think it's very hard to bet against China when it comes to investing generally, particularly for people with a long view. But returning to your question about debt, I think the thing for people to think about is, well, if there's less debt available, or if the debt costs a lot more, what will that do to equity returns? And the answer is, all other things being equal, they'll go down. But of course, all other things aren't equal. And when we look at our results in various kind of debt markets, you'd think there'd be a much bigger difference in terms of the returns from the different environments, but there isn't. There is a difference in the amount of transactions done. Because right now, or in the next year or so, that's going to be a spectacular time to invest in some of the markets that Jim was speaking about, particularly. The problem is there'll be a lot less transactions done. The sellers will want to, as best they can, hang on to their businesses because they know it used to be worth something and they hope it'll be worth that again, and they're going to fight for that. And if they can only hang on for X period of time, ultimately you'll get there. And so the deal transaction volume, I believe, will fall generally everywhere, and particularly in the developed markets here for a while. And eventually, sellers and buyers kind of get enough price discovery, and they get back in sync on what is a business really worth. But it does take a while for that to happen.
Yes. Yeah, and I would add to Bill's point, we're not in the market share game. We're not on the sell side at Goldman or Morgan. We want to do good investments. So with my private equity hat on, there will be 6-9 months of price discovery, and there will be that private family, third-generation company in Japan or in the U.S. that wants to sell. And yes, it might have been worth X, but you know what? Let's not wait around. We can invest it and make more money. So, again, to the point, these financing markets, there's a dislocation. It's going to cost more money. But eventually, prices will probably come down because the returns, we're going to be disciplined. Good investors are disciplined right now, but the cost of it, I've rarely seen a buyout that made a lot of sense at 7% financing and didn't make any sense at 9%. You're talking about the wrong company. So I think there's going to be a period of a lot lower volume, but very interesting transactions that if you can put them together, you'll do well.
And Shannon, if I can just add one point, I totally agree with what Jim's saying. I think the other thing we're also about to see is, I think we've made the point on the panel already today, is that over the last 10 years, there's been a rise of a whole range of managers who have only ever invested into a market where you had easy money and you had expanding multiples. But if you've been doing this for a long time and you're on vintage 6 or vintage 8, you've seen this before. So you've got more experience and probably a bit of scar tissue of knowing when to say no and sit on the sidelines and when to say yes. And I think this will be the time as people start to choose managers and continue to allocate capital, we'll see an unmasking of what's a good manager and what's a great manager with the right investment culture. Because it's not when things are easy that stands out, it's when things are tough. And particularly in a world, as Jim says, where there will be more scarce opportunities, it will come down to who's willing to pay a certain price, but it'll also come down to your network and the ability that if people want to do business with you because they can trust you to do business because you can get banked and the like. And so I think that'll be that's a really interesting next phase of investing, which I agree will probably last for, not 1 year, but, for multiple years. But I think that will mean that we will have some shakeout as well in the asset management industry.
The current economic conditions, market conditions, very much remind me of 1997 Asian financial crisis. Many of us remember that. And 2008, so-called global financial crisis. Yesterday, Mark Carney used the term, the Atlantic financial crisis, referring to the so-called 2008 financial crisis. He was right, because that financial crisis very much affected Western countries, the United States and Europe. Many banks failed, but it didn't really affect Asia at all. In 1997, 150 banks failed in Korea alone. And in Japan, a number of banks failed. Like Long-Term Credit Bank, Nippon Credit Bank, all failed. Throughout Asia, there were many bank failures. But in 2008 and 2009, to my knowledge, there was no bank failure in Asia at all. So the 2008 crisis didn't really affect Asia as much as it did Western countries. In that particular year, China's GDP, 2008, went up 9.6%. The next year, 9.2%. Whereas for the United States, in 2009, GDP came down 2.6%. So we went through a number of economic crises in the past. And from my personal experiences, I made a lot of money in those downturns in economic crisis. My second book, Money Games, talks about the acquisition of a major bank in Japan. And my third book is going to talk about a major acquisition of a bank, controlling acquisition of a bank in China. So I remember that the founder of TPG, David Bonderman, once said to me that if a deal is structured right, this type of market conditions is probably the best time to buy. It seems to me, Jim, from what you have just said, you agree?
I completely concur. I mean, I think that it's very easy to get caught up, and I do have. There's an underlying confidence that inflation will be tamed, whether that's 23, whether that's 24. I think the demographics around the globe, it will be tamed. And so how are you pricing it? How are you protecting yourself? But I think the great investment platforms, the great LPs, the great sovereign funds, if they look back at these periods of dislocation, I know I was experienced before coming to Apollo, and many of the post-Korea, Japan, those restructurings, they were incredible opportunities to buy franchises that were literally once in a generation.
Correct.
Now, I don't suspect you're going to see that in the U.S. I think the U.S., the greatest president of all time for private equity is covenant-light debt. The worst president of all time for distressed investors is covenant-light debt. And while defaults will, and I know because I'm in both businesses, but the reality is defaults will be higher the next couple of years. But I think, again, this lack of certainty, this lack of confidence, this is when you want to be putting money in the ground. We don't celebrate on buying companies. We celebrate when we sell them. And so, it's truly an amazing time.
What about public markets?
I know there's this sort of thing that private markets are great and public markets are, but maybe the truth is there's price discovery. Hang on. But maybe there's a thing of there's price discovery in public markets, and they're telling you something, and there's sort of one of the solutions to the denominator effect is maybe people in private markets to mark things to where they're now funding things rather than where they used to do them, and then you'd suddenly find the denominator effect went away. I think that the bigger picture is people have got used to the idea that sort of economic problems are short, maybe sharp, but they go away quickly, that buying dips has been the answer. And Jim's right, that there will be a moment where there are opportunities to buy things super cheap. But inflation in the US is only going to go away if they enter a significant recession. There's a real question of whether the Fed has got the sort of stomach to drive it this time. But today we have twice as many job openings as we have unemployed people. The point where you get rid of inflation, you've got to get rid of wage inflation. You get rid of wage inflation by having twice as many people looking for jobs as there are available jobs. Now, putting that in context, that maths would get you to something that looks like 10% unemployment. Right now, I don't think that central banks really have the stomach for that now, but we're either going to have significantly higher inflation remaining, which creates significant volatility in asset prices, and you look at the 70s, and over a 10-year period, there was a zero return to a real portfolio, zero real return to a portfolio. Bonds and equities, it was a lot worse in bonds and better in equities. You get real defaults, and out of that, we will create a distress cycle at some point. But I think we should recognize to deal with the economic problems requires some real pain, and sitting on a portfolio invested the way it's been for the last 10 years is going to be painful for it.
And if I could just support
the person who owned that UK sovereign debt piece, the 1.5s of 62, they know about pain going from 101 to 38. What you're saying is until we have capitulation, I agree. Listen, if you're an investor right now, capitulation is even a more enjoyable market. And yes, it's going to be a nasty fight to tame inflation. No doubt about it. I know that we have 30 to 40 private companies. I get a survey every month. And the reality is CEOs are in a slowdown mode. They're stopping hiring. They're stopping expansion. They're stopping digital ads. It's not going to be a 10-year process to slay inflation. It will happen in the next 24 to 36 months. It will happen. The world happens much sooner. I was around in 94. I was around in 87. What's happened in the last 6 months, 4 months really, in the bond market, the bond vigilantes are so far ahead of the monetary authorities in the West. And that will happen by the time we recognize that we are in a recession. The market will have anticipated that, and bond levels will be lower in the U.S.
And to agree with both of these guys on one point there, and it may sound like they're disagreeing, but one of the things that really is happening is the raising of interest rates yesterday at 3/4 of a point in the United States, and the last 3 meetings at the exact same amount. It's easy for Jay Powell and the Fed to increase interest rates when unemployment is 3%. Anybody in America who wants a job can get a job. If we get to unemployment of 6%, it isn't going to be easy for them to fight the inflation fight. I agree that we're going to fight. I think eventually victory will be declared not at 2%, but at some level higher than that. I don't know what it'll be.
Yeah, and also, like you asked earlier about commercial real estate, residential real estate. Residential real estate is actually fascinating right now. If you're a home builder, you are not selling a home in the U.S. Literally, you're not selling a home. I know, we own one. Rates have gone on a 30-year mortgage from 2.5% to 7%. On the other side of the equation, though, we have a deficit of 3.5 million homes in the U.S. A lot of equity in homes right now. Home prices are not going to go up 8, 10, 12%. They're going to go down. Do they go down enough to create a 07, 08 housing crisis? I doubt it. Maybe in some secular markets, but not in many. So my point is, I think that we have to remember the U.S. economy is so service-driven that the impact of higher rates, it's not like the 25% the industrial side of the business or the manufacturing side of the business. Rates are very quick in impact on that side. Having rates impact on the transmission mechanism takes longer in a consumer-driven economy. But it will. I mean, interesting. Airlines and hospitality doing very well. Home builders, used cars, autos, really proverbially hitting the wall.
I think the challenge today is somewhat different from 1997 Asian financial crisis and 2008 economic and financial crisis, in that in 1997, the market and the economies quickly bottomed out. And we knew that. It couldn't get any worse. In 1997, going back to Korea, the stock market dropped 49%. The currency dropped 65.9%. So combined, in US dollar terms, the market dropped 85% in just one single year. On October 23rd, 1997, the Hang Seng Index here in Hong Kong dropped 16% in one day. So we knew that the market was bottoming out very, very quickly, and therefore it was somewhat easy to conclude that it was time to be contrarian. It's time to buy. Today, I think the challenge is that we know the inflation is high. We know that central banks are raising interest rates, but interest rates are still negative in real terms. right? Inflation rate is 8%, interest rate is 4%, so you still have negative 4% real interest rate. And chances are the interest rates are not going to be high enough to put inflation rate down, to tame the inflation. But chances are the interest rates will be high enough to push the economy into a severe slowdown or even recession. And I think in the United States, it is a very interesting situation where the labor market is very tight. But in Europe, I think a recession is almost a certainty. So there is still a long way to go where the bottom will be found. And I think that's a challenge for us to figure out whether or not this is a good buying opportunity. But in the time remaining, I would like to give the audience opportunity to ask all these brilliant minds about whatever you have on mind.
He's talking about us, I think.
I'm looking at the 1 minute 27 on the clock.
I'm looking for the brilliant minds.
We need brilliant questions.
A short question.
Well, if there are no questions, that means you have addressed all the questions that everybody has in mind anyhow. I would like to thank this distinguished panel for your wisdom and for sharing your thoughts and your experiences. And this is extremely illuminating, and we thank you very much. Again, we thank HKMA and Hong Kong Stock Exchange for holding this great event. We're very happy to be here, which signals that Hong Kong is open and we're ready to do business. Thank you very much. Thank you. Thank you.
Thank you very much to Mr. Wei Shan for his able guidance for our panel. Gentlemen, our photographers are standing by. They would love to take your picture if they have that opportunity. Yep, don't leave the stage, Jim. Thank you. If you can just hold in there, we're going to get all of you to take a photo. Fantastic. There we go. Ladies and gentlemen, we will be taking a short break, but it is only a short one. Listen for my voice to call you back. Due to health concerns, we are not going to be serving coffee, but there is bottled water to keep you hydrated during the break. Keep an ear out, and we will be calling you back for our next panel very shortly. Thank you very much. Very good. Big smiles, gentlemen. There we go. Wei Shan, that's a big smile. That's what I like to see. Good morning once again. I'm back. Andrew Work here at the Conversations with Global Investors, a conversation with you and our panelists that we are about to bring on stage for the next phase of our event today on day 3 of the Global Financial Leaders Investment Summit. We are really excited to have another panel. We are talking about managing through volatility. These are definitely volatile times in the markets. Fortunately, we've got a great panel that's going to help us move through these volatile times. Our moderator for this panel today is a hometown hero. He is the Deputy Chief Executive Officer of the Hong Kong Monetary Authority. He is responsible for reserves management, financial infrastructure, and the exciting world of fintech. Please welcome our hometown hero, Mr. Howard Lee. Hey. Thank you.
Thank you. Thank you.
All right, Mr. Lee has a great panel lined up for you. First, we welcome Mr. Stephen Clark. Mr. Stephen Clark is the President and Managing Partner at Wellington Management. Thank you for joining us today. On stage yesterday and back again, we welcome Hanneke Smits, who is the CEO at BNY Mellon Investment Management. And next, we would like to welcome Cyrus Terpurvala. Cyrus is the President and CEO at State Street Global Advisors. Thank you very much for joining us. Howard Lee, take it away.
Okay, thank you very much, Andrew. And thank you all for coming. I think most of you have sort of listened to the previous panel moderated by Shank, which set a very high benchmark for all of us. And to the moderator, I'm under tremendous pressure because Shank was like a spreadsheet of data. He can recite the economic figure of any year you pick. But the good thing is he set the scene very well, and I don't need to labor on a lot of the background. And you also sort of listened to the panel discussion, Greg chats yesterday. So they provide a very good scene for our discussion in the next hour or so. What I would like to sort of add is maybe a little bit of reality check as well. Talk a lot about uncertainty, about risk, and just this morning we heard the announcement of the Fed to hike rate another 75 basis points, and there's a signal that don't expect the terminal value to be around 4.6 as previously expected. It could go higher, it could go longer, so pressure is really on. But even before that, as an investor, we look at the performance of our investment in the last 9-10 months. Public equities market generally down by anything between 20 to 30%, especially if you take into account exchange rate regulation. Even bond market 15-20% loss of value, pretty common. So we are actually licking our wound. Just now we heard that everybody seems to have unlimited capital to deploy, but a lot of us really thinking about how we account for the year. And I think later this month, Eddie and I go to LegCo to report our Q3 result. I'm still struggling how to piece together a story for that. It's not going to be pretty anyway. I would just like to put this in this perspective and then see how our managers help their clients manage their assets and how do they see the flows in this kind of environment. Now, I would perhaps start with Cyrus. I think a lot of the audience in the audience know that SSGA is a huge asset manager. One signature product is their ETF product on different markets, different products. Now, this is a pretty good proxy in the sense that under this kind of a very difficult market condition, a lot of investors would need to liquidate, would need to rebalance. So what kind of flows do you see among different products, different segments, and then even different geography of investment? How do we take a glimpse as to the kind of reaction of investors in this, and what kind of lessons we should learn over this, and what are their positioning going forward? So can you share some insight with the flow of data that you can see?
Sure. Thank you, Howard. And let me actually focus on the US ETF industry. It is a subset, but it's the largest part of the global ETF industry. Though I do think most of the trends are fairly similar across much of the world is what we're seeing in the US. And I'm intentionally going to focus on the ETF industry and not talk my own book. I find it gets me into less trouble with my compliance crowd. Let me pull all the way back. Combined US ETFs plus mutual funds. You put those together and you have $270 billion of outflows. $270 billion of outflows year to date. This is September year to date. You double click on that and you say, well, that's kind of interesting that you're in outflows because US ETFs are on track to have one of their best years ever. Comfortably above 500 billion is the current assumption for a full year, could cross 600 billion as well. And as you said, Howard, we look at the ETF flows because we think it's a very good indicator of how investors are actually deploying capital, but also the sentiment, because for a lot of investors, ETFs remain the most cost-efficient, transparent, and rapid way to put money to work. So what have we seen this year to date? First thing I'd say is money's been invested in flows across the major asset classes. So across the major food groups, both equities and fixed income, you've seen positive inflows. And let me just unpack each of those and maybe sort of pick on three areas. The first is fixed income. So over 100 billion this year of ultra-short duration government bond ETFs, and that's a record. Ultra-short duration. In the equity space, you could look at it multiple different ways, but I'll start with the observation we've seen over 50 billion going into equity dividend ETFs, and really we think of dividend as an interesting indicator of both value and quality. If you say, no, I want to be more simplistic about value versus growth, we would say the vast bulk has gone into value, not growth. If you're one of those sector kind of folks, the major inflows have been into healthcare, consumer staples, and utilities year to date. Again, the more defensive sectors, if you will. Pretty strong outflows from financials, consumer discretionary. And then more recently, we've seen some interesting positive inflows into energy and even technology. Let's pick on commodities. I do think it's interesting. Gold has seen about $3 billion of outflows. So that's interesting because typically and traditionally, when you're worried about inflation, you go into gold. And no, before you ask, Howard, I do not believe that all investors are going into cryptocurrencies as a surrogate for gold, so that's not our current thesis. And then what you've seen in October is very interesting. You've seen a complete reversal. You've seen $90 billion, $90 billion, flow into ETFs in more of a risk-on mode. So if you think about the first 3 quarters, it's been more risk-off. October's been big risk on, 90 billion. Let me put that all back into the broader sort of investor context of how are investors feeling about it, which was the other part of your question. I'd say very simply there's 2 types of investors that we see. There's the first type, which is they're going to stick with their strategic asset allocation. Many of our largest, most sophisticated institutional investors would fall into that category. And they're basically rebalancing, and there's a lot to do in terms of rebalancing, even without discussing the denominator effect, which I think the prior panel did very nicely. So you see that crowd sort of steady as she goes, keep calm and carry on. And then you've got the more tactical investors, and they are definitely in much more of a risk-off mode. Not surprisingly, we also run some strategies ourselves in a more tactical fashion. In our own tactical portfolios, we're 12 to 13% cash, And keep in mind, the strategic asset allocation to cash strategic weight is 0. So being 12 to 13 in cash versus 0 is quite a big statement. We are interestingly underweight fixed income. That's our biggest underweight, and it's barbelled. We have very short term, and then we actually like longer duration sovereigns. Think 10-year US Treasuries, for example. Fairly neutral on credit, underweight high yield. And again, this is all publicly traded, not private credit, as the prior panel talked about. You know, we are of the belief, and I think a lot of investors are of the belief, that the Fed will do whatever it takes to tame inflation, whatever it takes. So I think I slightly disagree with some of the prior panel on that. And the real question now for most folks is, well, what will it take? And is the cure for inflation going to be worse than the disease of inflation? And will it therefore tip economies into recessions? And very importantly, what does that do to corporate earnings? And that's the shoe that hasn't yet dropped. So we remain underweight equities. You could look at it, and at one lens, you could say valuations are looking more interesting, but we're not quite sure the E is yet sort of reset to where it needs to be. More broadly, I would just say the outlook for investors is very cloudy. We don't see people racing back into risk-on mode, though again, I will say we were caught by surprise with the October flows we've seen. I think before we see investors flowing back into the markets in a seriously big way, you'd have to see two things happen. Number one, you'd need to see the Fed, as well as other central banks, start to signal that they're getting closer to the end of their tightening. So you're going to see a yield curve that goes from inverted to flatten, maybe even starting to see it steepen before investors take that as a good sign. And the second is you're going to have earnings get a lot clearer than they are today. And we believe until those two signals arise, we'd be surprised if investors broadly got back into risk-on mode.
I see. Very good. Now, perhaps next I turn to Steve. In the previous panel, we heard quite a bit of a discussion, private, public, and that kind of a debate. I wonder whether Luke would rather stay in this panel than the previous one. But Wellington actually manage a diverse range of products, fixed income, equities, alternative, multi-asset. Now, with this environment, equities has seen a lot of correction, but still whether it's a good time to catch a falling knife is really a big question. Maybe everybody is waiting for the two signals that Cyrus just talked about, but still we need to deploy money. And obviously, alternative and private market has been gaining momentum in recent years, even not just traditionally the institutional investors, but the high net worth individual and even private banks are selling a lot of private investment products. So you overlooking this range of products. So what's your take of it? Do you see this trend in your perspective? And also in this kind of switch for different types of investors, what are the issues that they need to be aware of? Is it really a one-way street that will provide private equities, private investment will provide the stability and also superior return over time? The only thing you are foregoing is liquidity. Is it a good narrative of this?
Great. Thanks, Howard. And I want to thank Eddie and HKMA and the Academy of Finance for having the vision to host this event. And as I was saying to Eddie earlier, being in our offices, being with our colleagues who have served our clients so distinctively through a very difficult environment has been very important, and it came through the inspiration of this conference, so thank you. You know, as I think to it doesn't happen often that equities go down 20+% and bonds go down 15+% in the same year. It's usually there's
some diversification across those two. And I think what we've heard over the last few days that we would echo is this marks a change. There is a regime change of sorts in the macro world, in the markets, that we all and our clients and investors need to take hold of. And as we reflect on that, I'll only talk my book for 1 minute, unlike Cyrus, which is to say, when we think about the 10+ years that we've experienced of markets generally going up, of clients logically leaning into that and therefore investing in much growthier investments, in more yielding investments, that the time has come to revisit the asset allocation that will serve us well for the next 5 to 10 years, knowing that, as the previous panel said, none of us are going to predict exactly how it's going to unfold. But I think there's enough uncertainty that we have to respect a sufficient range of probability distributions to have an asset allocation that's going to be a little less all in on growth and the highest yielding opportunities out there. And so as we reflect on that and as we work with our clients and think about higher inflation, probably more volatility in inflation and in markets, you know, we're working with our clients on thinking through how to really get that asset allocation back to a more diversified and rebalanced, as Cyrus said, manner to really be able to navigate, knowing none of us are going to get the environment perfect. So a couple of themes I'd highlight. One is a greater allocation, and Luke will like this, greater allocation to absolute return market neutral strategies, leveraging global macro, leveraging long-short equity. But the idea that you want some portion of your portfolio to not be reliant on the beta of markets, you know, seems very, very logical and appealing. And we're seeing clients engage with us and move in that direction, again, to some extent of the portfolio. As growth has grown so much over the last 10 years and value has been such a painful trade, inevitably many clients find themselves overweight growth, even taking account of this year's market return. So we're seeing more of our clients engage with us on getting that balance right between growth and value, and typically increasing their allocation to value strategies, in some cases to value sectors like healthcare, and in some cases to countries that have a lot of value securities like Japan. So definitely value as a theme and getting that balance right between value and growth. And then, you know, you ask about privates, and we do see the value of privates. And in fact, there is a blurring going on between publics and privates. So just, you know, one example, if you take the first 20 years of the 2000s in the US, private equity-backed companies went from 2,000 to 8,000, and public companies went from a little over 7,000 to a little under 4,000. Mm-hmm. So if you look at the opportunity set, there's a blurring going on. Companies are staying private longer. So we do believe taking advantage of that blurring, having investments on both sides of the ledger, public and private, and in fact, in our case and with our clients, taking advantage of that late stage pre-IPO private equity arena is one that we think remains very attractive. And in fact, we're seeing greater interest in what I would refer to as hybrid strategies, strategies that are going to allow you to pivot. And I think, you know, you asked privates, publics. I think it really is company dependent. There are some companies in the private range where maybe you can go out and invest at attractive prices now, some that may still carry a valuation that feels rich, similar on the public side. But being able to arm the portfolio teams to be able to decide which privates to invest in, which publics, when to have a slightly bigger lean in one direction or another, we think will be attractive as we look ahead. Fourth, I would say, is real assets inflation hedging. It's been a painful trade for the prior years before 20. We've seen those allocations go down over the last decade, and now we're seeing them come back, and I think it's an appropriate part of an overall portfolio. And then lastly, yields have risen so quickly that there are some interesting pockets of risk return in the fixed income markets, depending on the client. So if you're a pension plan that's trying to match your liabilities, you know, 6% return in IG credit could be appropriate for a portion of your portfolio. If you're more return seeking and risk seeking, there are some attractive securitized sectors. If you look at some of the European credits, there are some very high yields, as we heard earlier, high single digits, low double digits. And if you can pick those securities right and stay away from the ones that are going to default and go away, that's a very attractive return. So those are all areas we're working on with our clients as they reposition their portfolios for this different regime looking ahead.
Well, you bring up a couple of very important points in the sense that first, this is a paradigm shift, a change in regime in terms of financial market. Second is you can rely a lot less on beta, and you need to have someone who can generate absolute return. And also private market is more important. That all points to the difficulty or the importance of selecting the right manager for this, instead of the kind of Ryan beta, every CIO is a genius in the kind of upmarket. So what you would advise on investor in terms of this kind of environment, because the regime change also means that really just like what our product fact statement suggests, past performance doesn't equate the future performance. So it's a regime change. What should an investor do to really find the right manager for them?
Yeah, so there's heavy competition amongst asset managers. So I think that's the good news, is that there is a lot of choice, a lot of due diligence that could be done to select who is the right manager for different areas. You know, and I would say, just to echo your point, if you stop the clock at December of 21, the return of equity markets was at historic levels measured over the prior 100 years in terms of the 3, 5, and 10-year return. So again, none of us know. That could continue for the future. But if there's any sort of a return to long-term averages, the amount of return from the betas could be less than we've experienced in the last 10, 15 years. And therefore, in order to achieve the returns that we know are needed for the end beneficiaries, whether they be retirees, whether they be scholarships for colleges, whether it be research, is going to need more alpha. And so selecting that alpha is really important. And the way we do it, because we're privileged, we have over 50 investment boutiques at our firm. We spend a lot of time holding them to a high bar to make sure that we have confidence they could deliver for our clients. We spend a lot of time looking at the data, but as you say, looking at the data in the context of a philosophy and a process. What is the market inefficiency you're taking advantage of? What is your edge? Is it a sourcing edge? Is it a security selection edge? Is it a research edge? And how could I see that in the numbers? And if you can see it in the numbers and you understand it and you can cross-check it and they're exercising their responsibility consistent with their philosophy and process, that gives us that higher confidence that they're likely to perform in the future, either like in the past or even better than the past.
Okay, thank you. Now, that brings me to Hanneke, because we talk about the challenges of not just investors, but managers. And I would add to that is with the market drawdown, with less money in the system as the central banks do kind of different pacing of a QE, the AUM of a lot of managers are actually coming down. That's a big issue to managers. So in this kind of environment, how do you think would a manager cope with that? And what should be the business strategy to cope with this situation? And some investor might even say that if I just buy US Treasury and I got 4%, 4 something percent without leverage, so why bother? Should I pay fee for you, and I may as well park my money until I see the signals that Cyrus talked about. So how should we, I mean, you in terms of a manager, deal with this kind of situation? Is it a challenge to you, or you see other opportunities?
So the good news is I do get to talk my own book. Is that what you're suggesting with your no, but joking aside, thank you for inviting me onto this panel, and actually thank you for having me again, I should say, at the conference. Look, uncertainty actually always creates opportunities, right? We do have the backdrop, to your point, that we've seen of a decline in AUM, both in the equity markets as well as in the fixed income markets. So when you run an asset management firm, as all of us here on the panel do, you just sit there and watch, and you see the value of your AUM go down. In our case, it's equity markets, fixed income markets, and it's also currency. About 50% of our revenues is ex-US, so over 50% dollar-based and 50% non-dollar. And in this environment with strengthening dollar, that clearly in the short term has an impact. So I sort of want to separate here between what it means for managing portfolios versus managing the business. From a business perspective, I think there are some big trends that sort of have been around for quite some time, right? And there's sort of around three areas. One is clients look increasingly for strong differentiation from active managers. So they're moving away from, managers that propose to be benchmark, to have more specialty active, and that can take different forms, that can take the forms.
I'm not sure Cyrus agree with you. Maybe I turn to him.
No. I'm going to go to the other side as well. I'm going to land on the passive too. So it's a so-called barbell approach. So it's hard to sort of sit in the middle of traditional active and traditional income. It's either more specialist or actually find solutions that you can deliver in a more cost-effective manner, and that's where clients look for more passive products, buying indices or indeed ETF solutions. We're seeing the trends of the demutualization. Clients, and Cyrus just spoke about that very eloquently, clients are getting out of mutual funds and more into ETFs, both passive as well as increasingly active, because they're more cost efficient and they're more tax efficient. So on one level, back to what they're looking for returns. The current markets, which they always of course do, but in the current market environment, what they're looking for is more outcome-oriented investing. So the absolute return strategies that Steve was just talking about, or they might be looking for inflation protection. They might be looking to manage their portfolios in a more tax-efficient manner. But at the same time, the underlying theme has also been that clients have been looking to reduce the cost. And they've also been looking to do business with fewer firms, which is why it's so important that for firms our size on this panel, that you actually can offer a wide range of capabilities onto your platform. So you sort of tend to think about it that clients can come shopping in our organization, and we offer different strategies, and we also have boutiques on our platform, and there are different solutions depending on what the clients need. So I think you need both investment expertise, and you need to be able to deliver that at scale in a cost-efficient manner. So investing in products, in your technology, in the wrappers is important. And then I would say the third piece underlying all of this has been the client experience in itself, that I know we've been investing in, and I suspect my co-panelists have been investing in as well. And this has been somewhat turbocharged by COVID, where we've all had to engage with clients virtually. I took on this role in October 2020, and as I thought about meeting clients,
that was an opportunity.
That was actually it turned into an opportunity. And of course, in the pre-COVID days, one would think, okay, I'm going to get on a plane, not very carbon friendly, but I'm going to have to go and see colleagues and clients around the world. And I did all those visits virtually. And now that I look back on it, I'm actually convinced I've seen more clients in a shorter amount of time than I actually would have achieved if I'd gone around the world to meet them in person. So having said that, coming out of this, what we're seeing is that clients want to engage differently. They do want that in-person contact, so it's actually great to be here. It's great to visit different regions of the world, but they want to see us in person less frequently, and they want to engage more digitally, so they need better analytics around reporting. You need to invest in a better digital experience. We're investing in a more appy experience where clients can get through an app content on their phone in a very timely fashion, in a very short fashion as well, with the appropriate analytics that are also going to provide tools around portfolio construction, asset visualization. So all of this means, you need to invest, and clearly that can be challenging in an environment where your AUM is down, but that's also where I would come back to say it's really important to have scale, which actually all of us on this panel do. So a number of trends that I think have been prevalent for quite some time about more active capabilities, delivering capabilities in a cost-efficient manner through new product technology, and actually investing in the client experience. From our perspective, are trends that are here to stay, and certainly we're trying to solve for.
Right, right.
Howard, this may surprise you, but I completely agree with what Hanneke said about alpha is going to be more important than ever. And yes, we're one of the largest beta providers in the world, but we also have alpha teams. Now, here's the problem with that. A lot of folks who claim they're delivering alpha, when you actually disaggregate their returns, you can explain away 80+% of their returns as being some form of a factor, which I would argue is not an edge, because you can get that a lot more effectively by buying that given factor if you want value as a factor. So I do think the true idiosyncratic alpha generators will be in greater demand than ever. But they're not as many as there are active managers who purport to be alpha generators.
Yeah, absolutely. And whether the alpha generated over time really commensurate with the fee that they are demanding, this is something that we always look at. And it's, there's a lot of managers who can consistently deliver that over time and through the cycle. I think this is a challenge that institutional investor faces. And with this kind of drawdown, in this kind of environment, I suppose a lot of investors would, because of the shrinkage of their own balance sheet, they become a lot more ruthless in cutting managers, switching managers. And I don't know whether this is something that would make you see the industry more competitive and so more difficult environment for everyone. And also, do you see a pressure on fee on this? Or because more people switching to active, probably that's a fee positive. But with this kind of environment, is it something that you worry you about the kind of pressure on fee as well? Anyone want to take this?
Well, I've been on many panels over the past 3 decades, and there's always been a topic on, is there pressure on fees? And I don't think that will really go away. So it really comes down to sort of the value for money concept, right? What is it that you're delivering for your clients? So if it's a true active strategy, are you delivering to the target, whether that's a benchmark-based target, whether it's an outcome-based target? And therefore are the fees appropriate? Equally, because of the pressure on fees, we've clearly seen the trend of clients switching out of traditional active into passive, and actually that's been relatively easy for them to do so and relatively rewarding from a performance perspective over the last 10 years. I think the current environment is actually a really good environment for active investment managers to prove their worth. Uncertainty creates challenges, but also really creates opportunities for the brave. The price discovery that was so much discussed at the previous panel, I have to say I agree with Luke, who mentioned very appropriately that price discovery is also a big feature of the public markets, and that is going to be even more important in the environment going forward. And there will be opportunities, and we see it in our own portfolios where we can find stocks that are outperforming the indices and delivering returns to clients, but you're going to have to look hard. And I suppose for the clients, to Steve's earlier point, they will need to continue to evaluate the managers. It is fiercely competitive, and then judge whether they are delivering to the stated mandates.
Okay. Thank you very much. Now, let's move on to a slightly different topic, which is something that we heard a lot about in yesterday's panel from Mark Carney, also Haneke as well, is ESG. Now, we all agree that ESG is a very important issue, and there's increasing awareness and importance attached to ESG. But from what you see, is this more talk about it, or from investor behavior, you really seeing more money flow going into it, and what kind of products or what kind of theme that you see would best appeal to investors, and how do you position your firm to capture this mega trend? So maybe I'll start with Cyrus.
Sure. I think it's very different in different parts of the world. So Europe, I'm sure Haneke will attest to, given that she lives in London, is very much still in sort of ESG demand is very high. I do think the US is becoming more politicized. And part of that, by the way, is I think there's a basic misunderstanding or confusion on what ESG means. And it does mean different things to different folks, so it's not unexpected that there's a confusion. I describe it as one of two different flavors, and unfortunately, the popular media, now aided and abetted by politics, sort of conflates the whole thing and mixes it all up into one big jumble. So you can think about ESG as an input, as you're looking along with the rich mosaic of more traditional financial metrics, how a company's strategy evolves, et cetera. You can think about ESG as another set of inputs, but you're using all of that in that rich mosaic to come out with the best portfolio that's going to give you the best risk-adjusted returns from your portfolio. So that's one definition. The other definition is, no, I want a positive ESG score portfolio, and therefore the objective function is now get me a positively scored ESG portfolio. And by the way, since nobody can agree on the scoring, you can do whatever you like with that. I was with a client some years ago who told me that in a year he had reduced the carbon intensity of his overall portfolio by over 25% in 1 year. He's one of the largest sophisticated institutional investors in the world, and I couldn't imagine how he would have shifted his entire portfolio. This would have been tens of billions of dollars of shifts. So I said, wow, that's really interesting. How did you do that? How did you not sort of impact markets? And I kept trying to wrap my head around this, and he said, Cyrus, I just changed data providers. So, there's a lot of greenwashing that goes on, and I think we just have to be very, very careful about that. For us, we come at this as, for us, ESG is about value, not values. And that's been our compass on this topic. Now, don't get me wrong, if a client wants to express his or her values, that's fine, because it's the client's money, it's not my money. I'm investing on behalf of clients. So if a client wants to remove, pick your favorite thing, tobacco, guns, what have you, from their portfolios, that's fine. But if we are making the decision, it has to be about value, not values.
I might just build on that. Very similar philosophy at our firm as Cyrus outlined. What I would say is the secular interest, demand, commitment to ESG is strong and growing. And it's becoming more nuanced, and I think there's a recognition that it's very complicated, and it needs all of our efforts and brains to actually really keep studying it and making good judgments. And it's not as simple as, we're going to define this company this way and that company this way by, these three scores. And so that is giving me a lot of optimism that, yes, the trend is real, but it's becoming more nuanced. So I just want to tell a story. I was in Europe several weeks ago, and a client proactively asked me about nuclear energy that previously that client had just said nuclear energy shouldn't have been something that would be invested in. And they asked how to think about defense companies, given that the NATO countries are going to invest 2% in the defense. So those to me were good examples of, yeah, it's a complicated question. It's not one anyone could just answer just like that. And we have work to do to incorporate all of these factors, as Cyrus said, to reach good decisions. And we too have applied a value approach, a non-concessionary. ESG factors are part of making good investments and generating returns for clients. And we think that the ESG factors are more and more influencing the prices of securities and need to be factored in order to do an excellent job for the client. So how we're dealing with it, we're kind of focused in 3 areas. Number one, our edge is research and engagement. So we are spending time with every company around the world where we have any of our clients' capital, and including some where we're considering whether to put our clients' capital at risk, and really spending time working with them on obviously climate issues, like what are your science-based targets to understand your carbon profile. But we understand there's a lot to be figured out. It might not all be buttoned up today, but it needs to be headed in the right direction. But it also involves other things, like if you take healthcare companies, understanding product safety and quality issues. If you take payments companies, cybersecurity risks. So looking at all of these risks that could impact different companies in different ways. We have a dedicated ESG research team that works alongside our equity analysts, our credit analysts. We tend to meet companies with those 3 analysts all together, really taking that full mosaic in to really understand and come up with good decisions in our portfolios. The second is there's a lot to learn, so we're doing a lot of primary research. We have engaged in 2 scientific research relationships, one with the Woodwell Institute around physical climate risk, mapping the risks around the world, drought, fire, heat, flood, and understanding the implications of those on capital markets, on the companies or municipalities that we invest in. And we have more recently entered into a research relationship with MIT's joint program on the science and policy of global change. And that research is going to be focused on transition risk. And how do we get to a more climate-friendly set of energy policies and principles? We probably can't just do it by flipping a switch. We actually need to think through each of the energy sources, think through the path to get to where we're going, and we're very excited about that research to allow us to engage with companies on how they can get to, what Mark Carney was describing, get to this path that we're heading. And then the last thing is, as Cyrus alluded, there are investment opportunities. If the world is committed to addressing climate change, there are going to be some growth businesses out there in helping the world get there. There are lots of companies that are really focused on helping the world get to a better place on climate, on other social issues. You think about food insecurity, water insecurity. And so for clients that want that, we have portfolios that are very focused on taking advantage of the growth opportunities of the impact that we're trying to create both in equities and bonds, but with a goal of achieving a return, not just achieving the long-term impact.
But I suppose this is still very much a life issue in terms of data, taxonomy, and even clients' understanding and his value and values of ESG and client engagement, I suppose, is very much important in addition to your engagement with companies, right? Okay, so with that, Hanneke, anything to add?
Yeah, no, I think you just made a very relevant observation. We spend a lot of time at the moment actually educating clients, clearly in terms of interest. A lot of it started with our European client base. From our perspective, most of our managers have actually their origins in Europe, so we feel very confident we actually have in-house strong ESG credentials. And I agree with Cyrus, this is really, we think about ESG as an input into the process and helping us determine the value of the underlying securities. But then once we go to the US, where the environment has become so politicized, I find when I speak to clients in the US, very quickly you get into a lot of potentially confusing conversations. Are you talking about ESG? Did you really mean sustainable or social impact? Are you boycotting energy companies? No. But so there's a lot of time spent on the educational piece. And then finally also working with regulators, right? It's really important, and regulators around the world, including here, have issued guidelines, and I think it's really critical because we need the end client to have confidence in the taxonomy, right? In the labeling of funds, in the taxonomy and vocabulary of ESG, because otherwise they actually won't be investing in it. And I think there's some really good work that has already been done in terms of clarifying that, and I know we're actively engaged. I'm sure my colleagues here on stage are actively engaged with the regulators as well to land that in a good place. And we've also been very pleased with the global coordination on the part of regulators. So for us, ESG is very similar to what Steve described, very much integrated into the research process. It is way more than the E, although that does capture a lot of the headlines. I spoke about this at the panel yesterday, that some of our research is showing that about $100 trillion is needed in capital, which will create, I think, very exciting investment opportunities to get the world to meet the goals that were set out in Paris of achieving net zero by 2050. But that, if we get there and we take advantage of these opportunities, I think there's sort of two wonderful outcomes. Not only will you get a massive payoff to society, right, to achieve these goals, but I also think it will really offer the opportunities for some very interesting financial returns. And being here in Hong Kong, I have to say it's somewhat reminiscent of the opportunity that China represented in the early 90s, and listening to Bill Conway talk about, the $350 billion in GNP that has become to $17 trillion. I don't know what the $100 trillion would equate to, but I do think it could be a transformational opportunity for the investment community, and that to me is exciting.
Yeah. Thank you very much. Now, we are a few minutes away from the appointed time for this panel. Perhaps I now open up to the floor to see whether anyone has any question for the panelists. We have microphone in standby. Yes, this gentleman over there.
Thank you for the fascinating insights this morning. My question is on ESG. Do you take a different approach to investing and ESG in Asia than in Europe? Because the challenges in Asia, especially on energy transition and a just transition, are very different from those that are faced in Europe.
I'll take a shot at it. Again, I think if you start with thinking about it as value and not values as your compass, then it will be different. It may be different in multiple parts of the world. But we actually start with the belief that we will need fossil fuels for the foreseeable future globally. So I don't think your question, which sort of embedded says that's not true for the developed world, but maybe true in the developing world, I would quibble with it. We believe we will need fossil fuels for the foreseeable future, and we believe that the large energy companies will need to be part of that transition over the next coming decades. They have the capital, they have the skills, they have the talent, they have the know-how, so they have to be part of this. And I do think that's some of the unintended consequences, and Hanneke, some of your points just sort of triggered this thought for me, that there are things that are happening in parts of the world that actually trouble us in the way people are going about the climate transition. And I'll pick on three. There's probably a longer list, but I'll try to be succinct. The first is decarbonizing a portfolio is not the same as decarbonizing the world. So we fundamentally believe in engagement, not divestment. Because you can decarbonize a portfolio really simply, but I'm not sure the world's a better place for it, candidly. The second thing, and Steve talked about this in his client that he met, in Europe in their conversations about nuclear. We do think the taxonomy is dangerous. We think this green versus brown should probably stay with kindergarten. I think it's a more nuanced conversation. We actually think, we like to think about it as a spectrum from dark brown, think thermal coal, all the way to dark green, probably think wind. But the actual movement, I would argue there's more value in moving the world from dark brown to lighter brown. And depending on your taxonomy, nuclear might still be in the lighter brown, certainly gas would be there. So we think there's actually more value there than trying to move from light green to dark green. But the world somehow, there's a part of the world and investors who aren't actually seeing that nuance. The third unintended consequence I'd highlight is, you've all heard about greenwashing. We're actually more worried about something in the public markets that I term brown spinning. What's brown spinning? Brown spinning is basically where publicly traded companies, under pressure from a certain segment of their investor base or the broader society, sell off their highest emitting assets. They just don't want to deal with it in the public forum. Typically, they sell it to private owners and other players at a discount. That's the worst of all possible worlds. You've reduced disclosure, you've put it in the hands of potentially an owner who cares even less about it than in the public world, and you probably have destroyed shareholder value because you sold it at a discount. So that's the sort of unintended consequences that we worry about, and I would say these are global. It's not just a developed market relative to Asia sort of unintended consequences.
Yeah, I think that's a very good point. I see one more hand at the back.
We have all seen China equity markets has been recovering over the past 2 days. We'd like to hear your view, independent and objective view about China equity market. Do you think it's cheap enough, or you want to see more? You see more downturn before it goes up? And if it's the later case, what are the key catalysts for you to see before you see the market to go up? Thanks.
Steve?
Sure. So, within the walls of Wellington, there are going to be many opinions about China equity markets or any equity market. But I would say, those of our teams that are very focused on China are definitely paying close attention at these levels. There are some interesting buy opportunities, and always done in the context of evaluating the backdrop. To the extent confidence grows around reopening, then there are going to be some companies that are going to have some big opportunities to grow revenue. So I think that's one thing. What we always talk about, geopolitical tensions, that's probably going to be one that has to be factored in and will ebb and flow over time. But in general, continue to have the view that there are a number of exciting companies in China that are broadening out the middle class, that are deepening the consumer sectors, that are deepening the healthcare sectors, and technology. There are just a lot of exciting opportunities. Any one company at any time might be more interesting than another. But in general, right now at these levels, I would say we're attracting interest and picking securities as best we can.
Okay. Now, thank you very much. And I think this brings us to almost the end of our panel. But before I close, because this is the final panel of these 3 days events, our caption or title of this panel is Managing Through Volatile Markets. And we heard a lot of discussion about the uncertainty, the risk. And at the end of the day, all of you are asset managers. A lot of those sitting here are your client or potential client, or they are more perhaps watching this panel through the television broadcast. So perhaps I give each of you 1 minute to sort of pitch to your client or give advice to your client as to, after all these discussions, these chats, how you would advise them on managing their assets going forward. Who would like to go first? Hanneke, ladies first.
Well, literally giving advice, I don't think will go over very well with my compliance team. So I'm going to take it slightly differently, if I may. I think uncertainty is actually a very exciting time for active managers. Someone much wiser and experienced than me said to me decades ago that what's really important in investing is obviously to pick well but be different, right? So you want to be if you look at a quadrant of consensus and non-consensus investing and you think about the efficiency of markets being right or wrong, you want to be non-consensus and right, and that's really how you generate returns for your clients. So as a firm that has most of our capabilities in the active space, this is really a great opportunity for our portfolio managers and research analysts to try and pick those securities and be, non-consensus and generate great financial returns. So that's actually where I'm very excited.
Okay, thank you. Very good. Cyrus.
I'm going to take a different angle on this rather than talk my own book, which is simply, I would say to investors, given the paradigm shifts, which I won't repeat all the reasons why there's a paradigm shift, really it's a great time to re-underwrite your strategic asset allocation. Are you actually allocated in line with your risk-return profile? For a lot of folks, the last 10 years has just been a one-way trade, and I think people have sort of lost sight of the compass of what is your risk-return profile, and make sure that your asset allocation is in line with that, and then frankly, keep calm and carry on.
Very good advice. Steve, you have the last words.
Yeah, I would just say the partnership between investment managers, the investment office of all of the clients out there, and the end beneficiaries has never been more important. And as Hanneke has said, the opportunities, this is when we should shine, all of us together, is when we make good decisions on behalf of the end beneficiaries through times that are uncertain, are emotional. This is our chance to come in, make the best decisions we can, and in aggregate, if we make more good decisions than bad, because we won't get them all perfect, we will add value to the end beneficiaries and help them get to a great place. So I approach the uncertain times with energy and enthusiasm, even though it's hard.
Okay, thank you very much. I see many people taking notes. I'm sure some of them will come up to you later and for more detailed discussions. But with that, that brings us to the end of this panel and actually this summit. And so let's give a big hand to the panelists.
And of course, a thank you to our moderator as well, Howard Lee. Great job.
Thank you.
Deputy Chief Executive of the HKMA, well done, sir. And if I can have the four of you forward, front and center for a photo, of course. I mean, volatility cannot be avoided, but at least now they've presented a little bit of a brighter picture on how, a little bit of a beacon in the stormy seas. So thank you very much to our panelists led by Howard Lee. All right, there we go. Big smiles all around. Excellent, excellent. Auditioning for your modeling careers. Very good. All right, thank you. All right, thank you once again to our panel. Now, ladies and gentlemen, we have one more speaker before we go, so I would ask you to remain in your seats. Thank you very much. We would now like to welcome to the stage the chairman of the Hong Kong Academy of Finance, coming hot off of the success of this entire week that we've had at the Global Financial Leaders Investment Summit with the big dinner at M+, Hong Kong's new landmark on the Asian cultural scene, followed by yesterday's successful conference that we had at the Four Seasons Hotel, where we were navigating beyond uncertainty. And today it was a conversation with global investors, with you. So to everybody here in the room and online, we thank you for joining us as we welcome to the stage the Chief Executive of the Hong Kong Monetary Authority, Mr. Eddie Yu. There we go. Take it away.
Well, I know I'm standing between you and lunch, so I'll be brief. And I'd just like to thank all the speakers coming to the conversations today. To me personally, I think they are some of the best minds in the industry. And every time I talk to them, I'll learn a lot. And I hope that you enjoyed the discussion today as much as I did. And this brings us to the end of the series of investment summit events. But I know that apart from the formal events here, there's a lot of things going on in town. Parties, events, seminars, drinks, good food, good wine. And the buzz and the energy of this city is coming back. And what's more is that FinTech Week is still going on. Rugby Sevens is about to come. So I hope that this week will really mark the beginning of our path to normality from now on. And finally, I would say that thanks very much for coming. And as I said yesterday, we'll be back next year, same time. I'll see you next year. Thank you very much.
Thank you, Eddie. Ladies and gentlemen, serious business and serious fun. Eddie Yu and Hong Kong. If you would like to review these proceedings or share them with your friends, it will be available on the Hong Kong Academy of Finance website. If you'd like to follow the AOF, you can get on their LinkedIn page and find out about what is coming up. And with that, we will close the week. Ladies and gentlemen, thank you for joining us. I'm Andrew Work. Go forth and prosper. Thank you.